Hi, Matt McAleer, Director of Equity Strategies. February 8th, just after the close, I'm with John Mousseau, Head of Fixed Income and our CEO. We're going to briefly cover some of the fixed income activity this week and then come back to me on some equity action. John?
Thanks, Matt. We've continued to see good demand for bonds since the beginning of the year. The 10-year U.S. Treasury yield is down to about 263. It's 5 or 6 basis points lower than it started the year. It rose a little bit, it's come back down, but what you have not seen is, so far, volatility in interest rates. We've pretty much centered around where we ended the year. So there's been good demand for tax-free bonds, good demand for bonds in general. Some of the sell-off that we saw in high yield has reversed so far this year. So it looks like that was a little overdone. And there's been a lot of cross currents in the muni market, not in the bond side so much as in what's going on in taxes. Everyone's coming up to April 15th, and in muniland, what that has meant is a look at what the non-deductibility of state income taxes and local property taxes mean for investors. Some of you have seen the headlines where people have been leaving some of the high tax states like New York, Connecticut, New Jersey, moving to places like Florida and Texas. That is for tax reasons, because the onus of the taxes is going higher because of the non-deductibility. Just in the last couple of days, President Trump has made some references that he might be open to changing that. That is really has a lot of political implications to it. We're going to write a piece on it, but in general, one of the things we worry about if a lot of people are leaving these states, you start to see budget estimates that are overestimating the actual revenue that they get. So all in all, it's been very good for bonds.
Thanks, John. Yeah, I was shocked today on Bloomberg when I pulled up the foreign rates to see Germany's 10-year bond under 10 basis points.
It absolutely makes U.S. interest rates look attractive to any place else around the world.
Right. Okay. Thank you, John.
Thanks, Matt.
Equity-wise, once in a while, the market acts reasonable. And over the last 7-8 trading sessions, I think the market has acted very reasonable. We talked about 2 Fridays ago, our weekly momentum indicators had stretched up into the 90s. In other words, 90, 92, 95% of all companies trading on the New York Stock Exchange were trading in with positive momentum. To get the momentum number to that level takes a lot of demand, and that's a number we usually get a little bit of a rest or a reset at, and that's what we've seen over the last 7 or 8 days. Very healthy, very normal. We saw it in the equity markets domestically. We've seen it in the foreign markets, specifically emerging markets, which had that good strong run December through January and now have pulled back. They pulled back into areas that are starting to look attractive for any additional buys. In the U.S., still growth over value. Tech remains a strong bid. Software is rock solid. We're also seeing continued strength in networking stocks, as well as on the other side over in healthcare and the medical devices, which we've mentioned multiple times. In terms of international, we're still leaning EM. We'll eat some of that volatility to own EM as long as their relative strength stays so superior to developed markets. We really need to see a bid out of Europe. If we could get a bid out of Europe, I think international could have a monster year this year. We've seen real strength in Latin America, nice strength in Asia. Just need Europe to get a bid. Where are we sitting in terms of positioning? U.S. fully invested. International, we have about 15, 16, 17% cash. Tactical, right in the 25% cash area. So we'll be looking to see if we get any further weakness next week. That's the type of weakness that can be bought, in our opinion, as long as you have a good defined risk-reward line going forward. So have a great weekend. We'll be back next week. Thank you.
Thanks, everyone.